video we're going to look at some of the forces that drive stock prices. This is not by any means exhaustive. There are other things that are not mentioned in this video, but it's a general introduction and it covers the main points. So we'll start by looking at the changes in valuation. This is mostly to do with PE ratios. That's, you take the price of a stock and you divide it by its earnings. So that gives you an indication of how cheap or expensive the stock is. And investors are willing to pay less or more for the money that stock's going to depend at various times and parts of market cycles. So if investors are really happy about a company and really think it's going to do well, they'll be able to pay more for the future cash flows it's going to generate. So looking at company prospects, expected growth of the company is reflected in its stock price. If a company is expected to grow very quickly, then people will price up the stock to reflect that. They'll think that the stock's worth a lot more because it's going to grow and generate more cash in the future. Companies that have got emerging market exposure often trade at a premium. That is to say that the stocks are valued at more because the anticipated growth rate is going to be higher. This also makes them sensitive to changes in emerging markets. For example, if China was to report bad GDP growth or lower than the market expected, these stocks would fall quite fast. And also, you talk about durable competitive advantage. Companies that are in a very strong competitive position and everybody understands are going to do well in the long term, these tend to trade at higher PE ratios because they're in a sense less risky. Companies like Coca-Cola justify quite a high PE ratio because that product is going to sell for years and years and years. So people aren't as worried about those cash flows. Macro factors, this is what you often hear in the news. This is the big picture, global economies. So rather than looking at individual companies, you're looking at the world or economy or a country as a whole. For example, GDP growth in recessions. If GDP is growing a lot, then stocks will be priced usually higher. In a recession, they'll be priced lower because their cash flows are anticipated to perhaps go downwards. People are spending less. Political instability can cause huge changes in pricing. If you're involved in mining stocks or oil, then changes in commodities and energy prices are going to have a huge effect. Quantitative easing, this is where governments prop up markets by programs of asset buying. For example, recently the Federal Reserve considered slowing down their quantitative easing, which had a big effect on markets around the world. Inflation or deflation. Deflation means that the real value of products that a company is selling is going down. Inflation can affect the return that you're getting on stocks, because you want inflation beating returns or else you're actually losing money. Currency movements, if your company gets a lot of its earnings abroad and those currencies weaken, for example Standard Chartered, the emerging market bank, which is based in Britain, listed on the London Stock Exchange, gets most of its income from Asia and reports its earnings in dollars. So if Asian currencies weaken against the dollar, Standard Chartered's reported earnings are going to go down. So that's going to change the valuation of Standard Chartered stock. Interest rates have a big effect on stock prices and bond prices. In a low interest rate environment, very high dividend yields are very attractive. But imagine the interest rates were 8% and the big oil company Shell was paying a dividend like it is now at 5%. Why would you want to put your money into Shell and earn 5%, excluding growth and all that, when you can get 8% virtually completely risk-free in the bank? You need to be compensated for taking on extra risk, so you would want a good income. Investor sentiment, this is a very big deal. The whole subject of behavioural finance deals with it. When investors feel very good, you can look at the dot-com bubble. Stocks trade at very high multiples. People are very, very optimistic, so they think that the future cash flows are going to be far greater, so they bid them up. But when investors are scared, when the markets are uncertain and moving very quickly, then stocks can trade at very cheap multiples. That's often where you get a lot of the best opportunities. You have what's called the flight to safety, where people take their money out of bonds, they take their money out of riskier investments, and then they put all of their money into government bonds and investments that, regardless of what happens in the market, are likely to preserve their capital. Often people buy gold for that reason. You get surprises and corrections. It's where a company beats the market's expectations or does far worse. So analysts think it's going to do this much, so that's priced in, and then the company announces that actually it's so much better, so the price has to correct upwards. Or if they announce they had a really bad year, the prices have to come back down to reflect the bad news. And prices correct to that information very quickly. You also have examples of forced buying and forced selling. If a company is included or deleted in an index, you've got a whole load of index funds and ETFs which have to buy or sell that. And when that happens, the liquidity changes. So people willing to buy those stocks that are flooding into the market are able to do so at a lower price. You also get brokers which lend money to hedge funds and proprietary trading desks and other sorts of traders. When markets get really volatile, they can call in loans or require more capital to be put up as security, and this can force certain types of investors to have to sell out positions very quickly. One of the famous examples is the Tiger Fund, run by Julian Robertson. Had a huge stake in US Airways at one point, and he had to sell out his stock very quickly. But since it was a big percentage stake in US Airways, it was very difficult to sell it, which drove the price down because of liquidity problems. Company news, things like dividend cuts. The day that the annual report is published, stocks usually move quite a lot. When management puts out statements saying how close they are to their projected full year earnings, that can move prices. Companies getting fined or more tightly regulated. Mergers and acquisitions. When these are announced, you've got people at Goldman Sachs, that's their entire job is to study this and try and profit from the changes in price. Debt announcements, things like rights issues where they issue more shares to pay for debt, or ratings downgrades, disposals where they sell off bits of the company, changes in people in the board of directors, appointment of a new CEO, things like that change. Buybacks, when a company buys its own shares, so increases the amount of ownership one share recognizes. All of these things make a huge difference in the price of a company. So hopefully this has given you a rough idea of what's moving the market and can help you make sense of changes in the value of your portfolio.